morning, madam and fellow classmates. We are from Group 6. Today, we will be presenting our ACC 426 Taxation 1 tax simulation based on the case study of Wong. This is the group members of Group 6. We have SITI, AZWA, SAFRINA, BINTI, SHAWAL, and me, FADHLIN, HUSNA, BINTI, ROSLI. Without further ado, let's begin our presentation with resident status. Resident status is very important in Malaysian taxation because it determines the tax rates and tax reliefs that an individual is entitled to claim. Therefore, before computing the income tax, we first need to determine whether Fuang is a resident or a non-resident. For the year of assessment 2020, Fuang stayed in Malaysia for only 32 days, from the 6th of June until the 7th of July. Since she did not satisfy any of the conditions under Section 7 of the Income Tax Act 1967, she was classified as a non-resident. Moving on to the year of assessment 2021, Fuang stayed in Malaysia for 213 days, from the 30th of May until the 29th of December. Since she was physically present in Malaysia for more than 182 days, she fulfilled the requirement under Section 7, 1, Section 1, 7, Section 1, Section A. Therefore, she is considered a resident for that year. Next is the year of assessment 2022. Although she was in Malaysia for only 42 days, she was still treated as a resident under the Section 1, Section D. This is because she fulfilled two important conditions. Firstly, she had been a resident in the two immediately preceding years, and secondly, she was also a resident in the following year. Therefore, she continued to enjoy resident status despite staying for less than 90 days. For the year of assessment 2023, Fuang stayed in Malaysia for 105 days. Even though she did not meet the 182-day requirement, she is qualified as a resident under Section 7, Section 1, Section C because she stayed in Malaysia for more than 90 days and she had been resident in at least 3 out of 4 immediately preceding years. Similarly, in the year of assessment 2024, Fuang stayed in Malaysia for 118 days. Since she fulfilled the same condition of staying more than 19 days and remained a resident in the required preceding years, she continued to qualify as a resident under Section 7, Section 1, Section C. Lastly, for the year of assessment 2025, Fuang stayed in Malaysia for 189 days, which exceeded the 182-day requirement. Therefore, she clearly qualified as a resident under Section 7, Section 1, Section A. In conclusion, Fuang was a non-resident only in 2020, while she was considered a resident from 2021 up until 2025. Now, I will move on to the computation of Fuang's statutory employment income for the year of assessment 2025. Employment income is calculated under Section 13 of the Income Tax Act 1967, which includes salary, allowance, benefits in kind, and living accommodation provided by the employer. Firstly, under Section 13, Subsection 1, Subsection A, this section covers all cash remuneration received from employment. For Fuang, this includes her basic salary, entertainment allowance, travel allowance, bonus, scheme of shares benefit, daycare benefit, and gym membership. Although Fuang received a travel allowance throughout the year, the first 6,000 ringgit qualifies for tax exemption. Therefore, only the balance of 4,800 ringgit is included as taxable employment income. After adding all the taxable cash benefits, the total income under Section 13, Section 1, Section A amounts to 138,427 ringgit. Next, under Section 13, Section 1, Section B, we consider benefits in kind provided by the employer. These benefits include the use of a company car, a driver, a maid, a security guard, leave passengers, and semi-furnished furniture. However, some benefits are exempt from tax. For example, medical and dental benefits are fully exempt, while only the taxable portion of the Singapore leave passage is included. After excluding the exempt items, the total taxable benefits income amount to 25,340 ringgit. Moving on to the Section 13, Section 1, Section C, this section relates to the living accommodation provided by the employer. The taxable value is determined by comparing the defined value of the accommodation with 30% of the adjusted employment income, and the lower amount is taken. In Fuang's case, the defined value of accommodation is lower. Together with the hotel accommodation benefit, the total taxable value under this section is 35,492 ringgit. After combining all taxable employment income, we obtain a gross employment income of 199,259 ringgit. From this amount, allowable deductions are considered. In this case, Fuang is entitled to deduct 2,000 ringgit relating to travelling expenses, because the allowable exemption has already been taken into account. After deducting the allowable expenses, her statutory employment income for the year of assessment 2025 is 197,259 ringgit. This statutory employment income will later be combined with her other sources of income, such as business income, partnership income, rental income, and other income, to determine her overall income tax liability.
Now we continue our presentation by explaining Fuang's statutory business income. So firstly, let us look at the computations of Fuang's statutory business income for the year of assessment 2025. The computations begins with the net profit of Fritzi Enterprise, which is RM 133,070 ringgit according to the financial statements. However, this accounting profit cannot be used directly for tax purposes because some items are either non-taxable or not allowable under the Income Tax Act. Therefore, several adjustments are required. The first adjustment is to deduct the dividend income of RM 13,000 because the dividend income is not treated as a business income under Section 4, Subsection A. Therefore, it should be excluded from the business income computation. Next, we add back non-allowable expenses. These include the remuneration paid to the business owner, such as basic salary, house rent allowance, and EPF contributions. Since Fong operates a sole proprietorship, payments made to herself are considered personal expenses and are not deductible for tax purposes. We also add back depreciations of RM 14,400 because depreciation is an accounting expenses. For tax purposes, depreciation is replaced with the capital allowance with a claim separately. Another adjustment involves the general provision for bad debts amounting to RM 12,000. This is non-deductible because only specific bad debts have actually become irrecoverable are allowed under the Income Tax Act. The renovation cost of the storeroom amounting to RM 11,000 is also added back because it is capital expenditure that improves the business premises rather than maintaining it. In addition, donations that do not qualify as business deductions, penalty for late payment of quit rent, business zakat and income tax expenses are also adjusted according because they are either restricted or specifically disallowed under the Income Tax Act. On the other hand, the business is entitled to claim double deduction for employing disabled employees. Therefore, the salary and house rent allowance paid to the disabled employee are deducted twice as an incentive provided by the government. After making all this adjustment, the adjusted business income is RM 228,750 ringgit. Finally, capital allowance of RM 20,800 is deducted to replace the depreciation, resulting in a statutory business income of RM 207,950 ringgit.
Next, I will explain the computation of Fong's partnership income. The partnership calculation starts with a net profit of 41,900 ringgit. However, just like the business income computation, several adjustments are required before arriving at the taxable income. Firstly, non-allowable expenses such as depreciation, partners' remuneration, interest on capital, and partners' drawings are added back because these items are considered appropriations of profit instead of business expenses. After adding back these items, the provisional adjusted income becomes 200,850 ringgit. Next, the partnership's private expenses are deducted. This includes partner remuneration, interest on capital, and drawings because they are distributed to the partners rather than being expenses incurred in generating business income. After these deductions, the partnership's divisible income is 122,275 ringgit. This amount is then allocated among the partners based on the agreed profit sharing ratios before and after the change in ownership during the year. Each partner's remuneration, interest on capital, and drawings are then added back to determine their individual adjusted business income. Finally, capital allowance is allocated among the relevant partners before arriving at each partner's statutory income. Based on the computation, Fong's statutory partnership income has become to 51,931 ringgit, while Naila's statutory income is 70,435 ringgit, and Jimmy's statutory income is 52,940 ringgit.
Now, I will continue with the Industrial Building Allowance or IBA. Industrial Building Allowance is tax incentive granted for qualifying industrial buildings used in business. In this case, there are two qualifying assets, namely the factory building and the heavy machinery installations. For the factory building, the qualifying costs include the architect's fees, preparations of plans, constructions cost of the warehouse, and the installations of water and electricity. However, the cost of land is excluded because land does not qualify as qualifying building expenditure. The total construction cost is RM 563,000. Since 15% of the building is used as office space, which is a non-qualifying purpose, only 85% of the total expenditure qualifies for IBA. Therefore, the qualifying building expenditure or QBE is RM 478,550 ringgit. For the year of assessments 2025, the business is entitled to claim an initial allowance of 10%, amounting to RM 47,855 ringgit, and an annual allowance of 3%, amounting to RM 14,357 ringgit. After deducting both allowances, the residual expenditure carried forward is RM 416,338 ringgit. Next is the heavy machinery installation. The machinery itself costs RM 80,000, while the cost of preparing the site is RM 280,000. Under the Industrial Building Allowance rules, if the site preparation cost exceeds 75% of the machinery cost, it qualifies as qualifying building expenditure. Since this condition is satisfied, the total QBE is RM 360,000. The business is therefore entitled to an initial allowance of Rm36,000 and an annual allowance of Rm10,800 ringgit. After deducting both allowances, the residual expenditure remaining is Rm313,200 ringgit. This industrial bleeding allowance help reduce the taxable income of the business by allowing the qualifying capital expenditure to be claimed over several years. Next is computation of FONG personal income tax for the year of assessment 2025. Personal income tax is calculated by combining all taxable income earned by an individual during the year. After that, allowable deductions and personal reliefs are claimed to determine the chargeable income before the final tax liability is calculated. For the first section is Section 4, Subsection A of the Income Tax Act 1967, it stated that FONG earned income from her sole proprietorship business. After deducting the capital allowance for the adjusted business income, her statutory business income amounts to Rm207,950 ringgit. In addition, FONG is also a partner in a partnership business. Her share of the statutory partnership income is Rm51,931 ringgit. Therefore, after combining both of the sources, her net statutory business income is Rm259,881 ringgit. For the next section is Section 4, Subsection B is for the employment income. FONG received employment income from her employer. As explained by the first presenter, after including all the taxable benefits and deducting the allowable expenses, her statutory employment income is Rm197,259 ringgit. This amount is fully taxable and forms part of her aggregate income. Besides employment and business income, FONG also received a rental income from a property located in Sepang. The annual rental received is Rm24,000. However, certain expenses incurred in generating this rental income are deductible, and these include the repair of the drainage system and the assessment tax, as these are maintenance expenses directly related to earning the rental income. On the other hand, the installations of an auto gate is not deductible because it is considered as a capital improvement that increase the value of the property rather than maintaining it. After deducting the allowable rental expenses, the net rental income is Rm13,867 ringgit. On the other hand, under Section 4, Subsection F, FONG also earned Rm2,100 by working as a part-time mathematics teacher. Since this income does not fall under the other categories of income, it is treated as other income and is included in the tax computation. After combining all the taxable income sources including business income, employment income, rental income and also other income, FONG's aggregate income amount to Rm473,107 ringgit. Next is the allowable donations are deducted. FONG donated activity books and also made a cash donation to Rumah Kebajikan Seri Tanjung, which is an approved institution. Under the Income Tax Act, donation to approved institutions are deductible subject to a maximum of 10% of aggregate income. After deducting the allowable donations, FONG's total incomes becomes Rm424,096 ringgit. The next step is to deduct all eligible personal tax relief. FONG is entitled to several relief including personal relief, medical checkup, child relief for Cindy and Jason, life insurance premium, medical insurance premium, EPF with its cap relief, lifestyle expenses, basic supporting equipment for her disabled mother, elderly care expenses, and also household equipment relief for the purchase of a home composter. The total amount of personal relief claim is Rm42,830 ringgit. Deducting all this relief, her chargeable income is Rm381 ringgit, 266,000. Finally, the income tax payable is calculated by using the resident individual tax rates. For the first Rm250,000 of the chargeable income, the tax payable is Rm46,900. The remaining of 131,266 ringgit is taxed at 25%, which amounts to Rm32,816 ringgit. Therefore, the total income tax liability for the year of assessment 2025 is Rm79,716 ringgit. Since there are no tax rebates available, the net income tax liability remains the same. To conclude, these tax computations demonstrate the complete process of determining an individual's income tax liability under the Income Tax Act 1967. We begin by identifying FONG's resident status, followed by the computation of her employment income, business income, partnership income, and also industrial building allowance. Finally, all of the sources of income were combined, and also the relevant deduction and personal relief were applied to determine her final tax payable. Overall, this case study has helped us understand how different types of income are treated for the tax purposes and also the importance of applying the correct provisions of the Income Tax Act to ensure an accurate tax computation. Let's conclude our presentation for today. Thank you everyone for your attention. We hope our presentation has helped you understand the tax computation process more clearly. Thank you so much.